The year 2024 brought significant changes to income tax laws that will affect how you file your income tax returns in 2025. These reforms, introduced against the backdrop of the general elections, include revamped tax slabs, new rules for capital gains, and revised TDS regulations, many already in effect for FY 2024-25. So, let's break down the 10 most significant updates. The new tax regime introduces revised income tax slabs aimed at providing greater benefits to individual taxpayers. Under the updated structure, income up to Rs 3 lakh is exempted from tax, while earnings between Rs 3 lakh and Rs 7 lakh are taxed at 5%. Income tax from Rs 7 lakh to Rs 10 lakh is taxed at 10%, and the rest bracket, that is Rs 10 lakh to 12 lakh, is taxed at 15%. For earnings between Rs 12 lakh and Rs 15 lakh, the tax rate is 20%, and any income above Rs 15 lakh is taxed at 30%. These changes offer taxpayers opting for the new regime the opportunity to save up to Rs 17,500 annually. Increased standard deduction limit. Under the new tax regime, the standard deduction limit has been increased to Rs 75,000, up from Rs 50,000. Family pensioners will also benefit from a rise to Rs 25,000. compared to the previous Rs 15,000. In contrast, the old tax regime keeps the standard deduction at Rs 50,000 for salaried individuals and Rs 15,000 for family pensioners. These high deductions in the new regime reduce taxable income, making it more attractive to a wider group of taxpayers. Enhanced NPS deduction for employers' contribution. In the previous tax regime, individuals claimed deductions of 10%. But under the new tax regime, individuals can now claim reductions of up to 14% of their basic salary of employers' contribution to the national pension system. However, contributions exceeding Rs 7.5 lakh across EPF, NPS, and superannuations funds remain taxable, ensuring balanced benefits within specified limits. Simplified capital gains taxation. The new framework has simplified capital gains taxation. Short-term capital gains, that is STCG, on equity and equity-oriented funds are now taxed at 20%. Earlier, it was 15%, while long-term capital gains on all assets are uniformly taxed at 12.5%. Equity and equity-oriented funds will still benefit from an annual exemption of up to Rs 1.25 lakh. While these changes make tax calculations easier, they also reduce indexation benefits for some assets. Rationalized TDS rates. TDS, or tax deducted at source, has been rationalized for various payments to reduce complexity, such as insurance commissions at 2%, rent at 2%, and e-commerce payments at 0.1%. This rationalization reduces upfront tax deductions, allowing taxpayers to retain more money initially. Claiming TDS and TCS credit against salary. Salaried individuals can now adjust TDS deductions from other income sources against the TDS on their salary, helping alleviate cash flow issues and increase their monthly in-hand pay. Changes in TDS on property sales. TDS is now applicable on the entire sale value on property sales exceeding Rs 50 lakh, irrespective of individual sellers' shares, enhancing compliance and preventing TDS evasion. Vivad Se Vishwas Scheme 2.0. Reintroduction of the Vivad Se Vishwas Scheme 2.0 to help resolve ongoing tax disputes amicably. This cuts down uncertainties and provides taxpayers with an opportunity to settle their cases efficiently. Aadhaar mandatory for ITR and PAN applications. Beginning in October 2024, individuals will be required to use their Aadhaar number rather than the Aadhaar enrollment number for filing ITR and applying for PAN card. Those without Aadhaar will encounter challenges in completing these processes. Reduced time limit for old ITR revisions. The time limit for reopening old ITRs has been shortened to 5 years for cases involving income escaping assessments above Rs 50 lakh. This change is intended to reduce lengthy litigation and offer greater clarity for taxpayers.